Hello everyone, welcome back to another video. If you're new to this channel, my name is Farhan and I help accounting students like you ace your exams. So what we have got here today is a practice question for the topic correction of errors. This is a second example which we are attempting today. I've also uploaded a video just 2 days ago which you could check on this topic. So you will see the question on the left hand side of your screen, and on the right hand side we have all the workings which I'll explain and go through step by step. So let's begin. Goku owns Funny Comics, which retails in comics and magazines. On 31 December 2023, he had discovered the following errors made by his inexperienced accounts assistant. So here we have got 5 errors that we have figured out on 31 December 2023. And the requirement in this question is to prepare the journal entries to correct these errors and also to name these types of errors. Okay? All right. So let's look into the workings now on the right hand side. Starting with the first error. Office equipment repairs amounting to $4,500 was recorded in the office equipment account. When we think of office equipment repairs, this is basically an expense which we have incurred, specifically known as the repairs expense. But we ended up mistakenly recording this in the office equipment account, which is a non-current asset account. As you can see, expenses and assets are different categories to each other. All right? When we make mistakes, which involves recording the transaction in a different category, that's when we can classify that as an error of principle. The key word here is principle because the error is mainly in the fundamentals, which is the category where the expense incurred has been wrongly treated as the purchase of a non-current asset. Okay? So we call this an error of principle because expenses incurred have been recorded as the purchase of non-current asset. All right? So anytime when you will see there's a mistake which has different categories involved, you will know straight away that it is an error of principle. Okay? Now, how do we correct this error? To correct this error, we need to reduce the $4,500 which we had previously recorded in the office equipment account. So when we had previously recorded that error in the office equipment account, we would have debited the office equipment account, right? Because we would have shown it as the purchase of a non-current asset, and when assets go up, we would have debited it. So previously, when we made the mistake, we would have debited the office equipment account. But now that we have to correct it, we would reduce that office equipment account. And how do we reduce it? We credit the office equipment account, because office equipment, as we understand, is a non-current asset account. And when non-current assets are reduced, we credit it. Okay? And what do we debit it? We debit the repairs expense, because expenses by default, whenever they're incurred, are always debited. So debit the repairs expenses by 4,500, which reflects the fact that expenses are increasing. And then we credit the office equipment by 4,500, which basically decreases the assets and also removes the mistake which we had previously done. Okay? All right. Now let's look into the second error that we've got. Commission received of $900 was debited to the commission income account and credited to the cash at bank account. All right. So I'm just going to highlight some key words here. Now, when you're receiving commission, you are receiving cash. And from your perspective, if you are receiving cash, your cash, which is an asset in itself, is increasing in value, right? So when assets increase in value or when assets go up, how do we journalize them? We would debit it, right? And income account in itself is always credited, because by default, income and revenue accounts, whenever they increase or whenever we earn them, they're always credited. Simply because they're the opposite of expenses, which when we increase, we debit them. But when we got income, when it increases, when we got revenue, when it increases, we credit them. Okay? Now, so the correct entry, as you understand, would be to debit the cash at bank by 900 because we're receiving some money in our bank account, and to credit the commission income by 900 because we have earned income, and anytime we earn income, we credit it. Okay? But what my inexperienced accounts assistant had done was to record it the exact opposite, where the commission income account was debited by 900 and the cash at bank account was credited by 900. So you can clearly see that this is exactly the opposite of what we are supposed to do. And that is why we can call this an error of complete reversal. Complete reversal here simply means that you did exactly the opposite of what you're supposed to do. Okay? Now, we want to fix this. So we want to make sure that we fix our wrong entry in such a way that we arrive at a net balance of 900 debit for cash at bank and a net balance of 900 credit for cash at bank. Now, the journal entry for fixing this can be a bit complicated. So I prefer to explain this using a ledger account. So I need your attention on the left-hand side where I'm going to prepare a ledger account. All right. So starting with the ledger account for cash at bank. All right. So it's going to be a bit rough. So I apologize for that. So I'm just going to draw some free lines, which are the usual 5-column format. All right. So in the first column, we have got date. In the second column, we've got details. Then we've got all the debits followed by all the credits. And lastly, we report all the balances. Okay. I mean the net balances that we have got. Now, what I would want to do first is record the wrong entry that my inexperienced accounts assistant had done. My inexperienced accounts assistant credited the cash at bank account by 900, right? All right. So what I'm going to do, I understand that this ledger account for cash at bank is credited by 900, okay? And the details here is basically the commission income that we received, which would have left us with a net balance of 900 credit because we only have credits so far. But we obviously understand, based on the correct entry that we have done, that this is fundamentally wrong. An error of complete reversal has occurred here. And we understand that in the correct entry, we would want the final balance for our cash at bank account to be 900 debit. Okay? So we need a final balance of 900 debit. Okay? Final balance. So that's the key word here. So if we need a final balance of 900 debit, which is what you can see I've just written in the last column, yeah? Okay, 900 debit. How can we achieve this? To get a 900 debit, we need to have 1800 here on the debit side, which can offset the 900 credit that we had from the mistake we had done, and ultimately or eventually leaves us with a final balance of 900 debit. Okay? So what do we write here as the narration again? In the details column, it's definitely the commission income. Okay? So you understand that to fix this, the cash at bank account has to be debited by $1,800. So if you check the entry where we have fixed this error, we have debited the cash at bank by $1,800, so that eventually we arrive at a net balance of 900 debit. Okay? Now you could repeat the same thing for commission income, which would obviously have a credit balance of 1,800, so that the journal entries equal out each other in pairs. Okay? So the correct journal entry in this case is to debit the cash at bank by 1,800 and to credit the commission income by 1,800. Every time you have an error of complete reversal and you want to fix this, you will know for sure that the amounts have to be doubled in order to offset the previous mistakes which we had done, because the mistakes were done in terms of debits and credits. Because we are doing accounting and we want to keep a track record of every transaction or event that occurs in the business, we cannot just simply cancel those away or tear the paper from the book and get rid of it. We need to have a track record of every single correction that we have also done along the way. So that is why you have to debit the cash at bank by 1,800 and credit the commission income by 1,800. Okay. Now, let's move to the third error which we have now. So a purchase of computer costing $3,100 was wrongly recorded as $1,100. The computer was purchased on credit from Dell Comps. All right, so what's the error in this case? It's basically we under-recording what we were supposed to record. The main amount was 1,100. Sorry, the main amount was 3,100, all right? But we ended up recording it as 1,100. This is what we can classify as an error of original entry, which is the error we make when we overcharge or undercharge. That's it. It could be also, let's say the computer costed $5,000, but we ended up recording as $8,000. Okay. It could also be that. So what we're going to do in that case? So we will also classify that as an error of original entry. Okay. So we understand that the computer costed 3,100, but we ended up recording as 1,100, which means we failed to record 2,000 more. Now, how do we record 2,000 here? We have to increase the value for computer, which is a non-current asset in our books. So when we increase our assets, we debit it. So we are debiting computer by $2,000. And at the same time, we have to increase our obligation or liability to Dell computers by $2,000. And when liabilities increase, we credit them. So you can see I've written here other payables, Dell computers. The reason I wrote other payables instead of trade payables is because this is not the purchase of inventory. Inventory is something that we buy from our suppliers on credit and sell it to our customers in our business. But this is the purchase of a non-current asset on credit. So therefore, we shouldn't use trade payables because this is not part of our usual trade, but rather you can call it other payables, specifically the account of Dell computers, okay? So based on this entry that we have fixed here, we debited the computer by 2,000, which is to increase the amount of assets we've got in our books, and we credited other payables for Dell computers by 2,000, which is to increase the amount of liabilities we've got in our books, okay? All right. Now, let's see what's happening in the fourth error. A sales invoice of $1,700 relating to a credit customer, Tony, was accidentally left out by the accounts assistant. So the key word here is accidentally left out, which is very simple for us to identify the type of error, which is an error of omission. Okay, so we have got an error of omission, which means we have completely forgotten to record this, which means we just have to record this transaction again right now. So this transaction relates to a sales that we have done on credit to Tony, who is our credit customer. Every time you make a credit sale to your credit customer, your assets, which are your trade receivables, increases. Trade receivables refer to credit customers of the business, and these are the people to whom you have sold on credit, and these people have promised to pay you in the future. That is why they are your assets. There are some economic benefits attached to it, like it's a transactional relationship. So we will debit the trade receivables, specifically the account of Tony, by $1,700, which increases our current assets. And at the same time, we have made some sales, which is revenues which we have earned. And if you recall our discussion for error number 2, we said that every time you have income and revenues that you have earned, you always credit it. So we will credit the sales revenue by $1,700. Okay? So debit the trade receivables specifically the account of Tony by 1700, and credit the sales revenue by 1700. Okay? All right, so let's move to the last error which we've got. Payments of check $2,600 to credit supplier Sean has been entered into Swan's account instead. All right, so this is what we call an error of commission. And how can we identify an error of commission? So Sean and Swan both are credit suppliers of the business. Both are your trade payables. You see the key word here is trade payables. I haven't said other payables because they are my suppliers. So that's why I'm calling them trade payables. Now, we made a payment to Sean, but we ended up recording it in the account of Swan, and both of them are trade payables. So this error is falling in the same category of trade payables or liabilities, but in the wrong accounts, because you can have multiple trade payables or credit suppliers in your business, right? So you made a payment to one of the suppliers, but you made a mistake by recording this in the account of the other supplier. So what do we have to do? We have to increase the obligation of the liability we have with the other supplier, which is Swan, okay? Previously, Swan would have been debited when we have made the payment as a mistake, right? Now, if we are fixing it, we have to increase our liability again with Swan. So that's why we're crediting trade payables by Swan, 2,600, because when liabilities increase, we credit them. At the same time or simultaneously, we will reduce our liabilities or obligation we've got with Sean, so trade payables for the account of Sean, by 2,600, because obviously our liability is going down. Okay, so when liabilities go down, we debit it, which is what you can see we are doing in the account for Sean. And when liabilities increase, we credit it, which is what you can see we are doing in the account of Swan. So both are $2,600. Again, just to simplify, error of commission occurs when you've got the same categories involved but the wrong accounts. And as we understand, the same category here refers to the category of trade payables or credit supplies, and the wrong accounts is you recording it in the account of Swan instead of the account of Sean. Okay, so you could have multiple suppliers in your business as well. Okay, all right. Right, so that's all for today's lesson. If you found value in this content, make sure to drop a like and subscribe to this channel. And you can check the link in the description to book a free Zoom call and discuss your monthly coaching requirements. And I'll see you in the next lesson.